In today's video, we're going to go through a quick overview of how to navigate your Mortgage Coach presentation, along with a breakdown of what to expect for your settlement costs. So by now, you have probably received your individual Mortgage Coach presentation. When you open up that presentation, you'll see a few financing options side by side based on our conversation about your goals for your upcoming purchase. I would have included a video just explaining the differences between those options. And now I'm going to show you what that Mortgage Coach presentation offers to you as far as information. So when you open up your individual link, you're going to see those options laid out for you side by side. It's going to show you your purchase price. In this case, we're using a $600,000 mortgage. It'll show you your mortgage amount. So we have a 10% down payment here, a $540,000 mortgage. Your interest rate, which will be based off of your credit profile and the rates for those days. Every rate quote that we send out for Long Island properties will be for a 90-day lock. We'll have your monthly payments, which include property taxes, homeowners insurance, and mortgage insurance, and then your cash to close. This figure represents your down payment and your total settlement. Again, we're going to go through that settlement line by line in a couple of minutes here. The Mortgage Coach presentation allows us to compare monthly payment savings. It allows us to compare savings over a certain period of your loan term. You can see that on the right-hand columns here. And it's also going to break down the settlement costs and the monthly payments for you. You could access that by clicking the More Info box here. And we are going to open up to a monthly payment breakdown screen. So your monthly payment is comprised of a few components. You have your principal and interest, which pays back your mortgage in full over your term. So this is your minimum monthly payment. You have your property tax collection, homeowners insurance collection, and any mortgage insurance that's due that gets separated and put into an escrow account. That's a savings account that's managed by us as the bank to make these payments when they're due. And when we combine those numbers, we're going to have your total monthly mortgage payment. Again, principal and interest cannot increase on you on a fixed rate product. Escrow, we just have to keep an eye on your property taxes, homeowners insurance, and adjust for any changes in those costs on an annual basis. The next tab at the top will take you to a closing cost breakdown. Closing costs are broken up into a few different parts, or settlements broken up into a few different parts. You have your bank-controlled fees, which would be these APR costs, your non-APR costs, which is third-party services, title company, mortgage tax attorneys. We'll go through that in a second. And then your prepaids. This is for your property taxes and homeowners insurance. You can access a full list by clicking the fee detail button at the bottom, and this will give us an itemized breakdown. So the fees that the bank control are the top 6. They say APR yes. Embrace Home Loans, our current underwriting fee is $14.95. It's contingent on us getting you to the closing table. So there's no upfront fees, no obligation for anything we do. Once we get to closing, there is a fee passed on to you as the buyer for the cost of the processing of your mortgage application. That's the $14.95 cost here. The other APR fees are third-party services that we don't profit from. They're independent companies. They're approved by us as the bank to protect against fraud. So they're services that you need to obtain your mortgage. We control the provider to protect against fraud. So first fee that we have listed here is an appraisal fee. This is for the value of the property that you're buying. An appraiser is going to go to the home. They're going to measure. They're going to take pictures, they're going to put together a report, and they're going to compare the house that you're buying to other homes that have recently sold in the town that you're buying from. So usually these reports will work in a circle and they'll expand out, and sales in the most recent 6 to 12 months will be used to determine a valuation on your property. That's going to ideally match up with the price that you're paying for the property, and that's going to confirm that the mortgage is leveraged correctly. There's enough collateral in the home for what we're lending. Conventional appraisal fee costs $540. That covers the appraiser's fee, and it also covers a management company that's involved in the ordering and the appraisal process to protect against fraud on the lender side of things. Credit report, we're going to run your credit report. We pull our reports directly from Equifax. They charge $21 per borrower. It's a one-time cost. Credit reports are good for 120 days. Depending on the time frame for your home search, we may need to update your credit at some point in the future, but you are not charged any additional fees. So again, there's a cost that is passed on at closing, contingent on closing. MERS registration fee. So this is for the electronic recording of the mortgage that you're taking out. Everything is going to electronic databases. This helps the industry protect against fraud and keeps everything organized. So the MERS registration for the mortgage that you're taking out is just under $25. Flood certification. Every property needs a flood certificate in it. That flood certificate is going to show whether your property is located in a flood zone or not. If it is in a flood zone, it'll show us what type of flood zone it's located in. It's also going to enter your mortgage into a lifetime monitoring service. So if at any point in the future the flood maps are changed, you'll be notified as the homeowner and will be notified as the lien holder on the property in case flood insurance needs to be put onto that property. And attorney fee. So there are 3 attorneys involved in your transaction. You have a settlement attorney or a bank attorney. That's a licensed real estate attorney that is approved by us as the bank to handle settlement for us. New York State is one of a handful of states that require licensed attorneys to handle settlement on residential real estate purchases. Our bank attorneys charge $9.95 for their services. Again, contingent and collected at closing. The rest of the closing costs are going to be controlled by your attorney and the title company that they choose. A lot of these costs are fixed in. They're determined by your purchase price, your mortgage amount, the property that you're buying, location that you're buying. I estimate your attorney fee at $1,500. This is something that you typically will pay separately from settlement, so it may look like I over-disclose to you, but this is something that we have to factor in as a cost when you're buying a house. Again, your attorney is going to typically choose the title company that's used. This is a service that you could shop for, so always recommended that you ask for a preliminary bill just to make sure that there aren't any exorbitant costs on there. The numbers that I show you, I pad them slightly just to have us ready for a worst case scenario. I want to make sure that the plan we're putting in place, we don't have our buyers bringing $1 more than what they're expecting to closing. So title company is going to run searches against the home that you're buying, the seller, and you as the home buyer. What they are identifying are mortgages, liens, judgments against the property or any parties involved in the transaction. They're going to be pulling up tax searches, street reports, permits, COs, property violations. There's a number of searches that the title company is going to perform, and those searches are going to allow them to put together what's called a title report, which is sent out to the bank, it's sent out to your attorney, and that title report is going to help identify any issues and make sure that all liens are paid off at closing and the property transfers cleanly from the seller to you as the home buyer. So I estimate that the searches will total up to $1,100. It's a couple $100 higher than what we typically see on the final bills. It's one of the costs that I do have padded. The title company is going to record your deed and the mortgage that you're taking out with the town that you're buying in. So for this scenario, I'm using a Suffolk County property. I estimate the recording fees for those 2 documents at $1,475. Again, it's a few $100 higher than what we typically see on the title bills, and a few $100 higher than what the towns actually charge. The title companies will most likely charge some type of processing fee for their role in the recording process after closing. But again, something that we have padded here. Title companies are going to issue you 2 insurance policies, your lender's title insurance policy and your owner's title insurance policy. These will be the same no matter what title company is used. They're determined by New York State, and the costs are factored by your purchase price and your mortgage amount. Your lender's policy insures the lien. It insures us as the bank. So we're, in this case, lending a $540,000 mortgage. That mortgage is going to be recorded on the home. If we go back to what the title company is doing with their searches, they're identifying any other liens that are currently filed against the property. So if that title report came back and they said, hey, we have a $400,000 mortgage with ABC Bank, that mortgage is paid off. Embrace Home Loans, our mortgage is put onto that property, and we are now the first lien holder. The whole system relies on the recording of these documents. So in some cases, there might have been a mistake or a missed recording in the past. So this insurance policy protects us as the bank. It protects you as the new homeowner if any liens from previous owners come up after you close. So all of a sudden you're in the house and you get, another letter from ABC Bank, and they said, hey, we also had a home equity line on this house that wasn't paid off at the closing. Maybe the lien wasn't recorded properly. It didn't come back with the searches. This policy is going to cover the legal process to remove that lien. You're not personally liable, but it is a lien against the property that you now have ownership of, and it also takes precedence technically over our lien. So this is very important for both the bank and for you as an owner. The owner's policy is based off your purchase price. It's a larger amount. This is going to protect your ownership. So if there is if there are ever any claims of ownership to the property from fraudulent deeds in the past, misrecorded deeds, anything like that, this policy is going to protect you. It's going to protect the legal process to make sure that that's rectified for you and there's no threat to your ownership of the home. New York State is, again, one of a handful of states that charge mortgage tax on residential real estate purchases or transactions. In Suffolk and Nassau County, the mortgage tax cost is 0.8% of every dollar that you borrow. Us as the bank, we pay 0.25% on our end. And then the last closing cost that you would incur would be for a survey. So, there's going to be a few inspections of the property. The first is your actual home inspection. This occurs after you have an accepted offer. Your realtor most likely will set you up with a home inspector who's going to go into the home and make sure that you don't have any major issues. So, they are looking at the foundation, they're looking at the electric, they're looking at the plumbing, they're looking at all the big ticket items of that home, and they're going to give you an inspection report that advises you, again, if there are any major repairs needed, what the lifespan on certain bigger ticket items like your hot water heater, your boiler, your roof, that report's going to give you a really, really good idea of the bones of the property. We don't show you that cost. It's probably going to run you about $500 to $600, I'd say today for an inspection. The seller does issue you a $500 credit back at closing, so that's going to wash out. The appraisals for the property value. The survey is for the map of the home. So a survey is one of those topographical maps that you'll see of a property. It'll show the structure of the property, it'll show your driveway, your property lines, deck in the backyard, pool, whatever's on that property. It's going to map it out. And your attorney is going to use that survey to compare to the title report to identify any potential permit or CO issues. So if your attorney is looking at the survey and they see a 20 by 40 foot pool in the backyard and there's no CO for an in-ground pool, they're going to go back to the seller and going to say, hey, where's the CO for this? And that's going to identify potential issues. It could also identify issues with property lines. Maybe your neighbor put up a fence that's 5 feet in your property. You want to address that before you close. So survey is very important. We don't require them, but most likely you're going to need one for closing. I'm showing you a new survey fee here, $700. You most likely will also have an option to try to locate a survey that's been done in the last 10 years, maybe by a previous owner. If they did any work to the house, they bought the house in the last 10 years, they might have a survey that can be used for an inspection to see if there have been any changes to the property. So those are your closing costs. Closing costs only make up about 50 to 60% of your settlement, depending on your total property taxes. The other part of your settlement is going to be your prepaid costs. This is property taxes, homeowners insurance, and any interest that's due at closing. So for this property, we're using a Suffolk County property. It's a little bit different in Nassau, but the numbers will work out very, very similarly. So for this property, we're using $12,000 in taxes. In Suffolk County, that tax bill, that tax cost is broken up into two different bills. You have your first half bill, which is due in December. It covers December 1st through April 30th. And then you have your second half bill, which is due in May. It covers May through November 30th. So the tax bills cover 6 months in advance. As the bank, all we're concerned about is the next tax bill that is due. So if you were closing in January, your first payment on the mortgage would be due March 1st. We have your taxes factored into your monthly payments. So each month, $1,000 is separated from your monthly payment in this scenario, put into that escrow account, and that balance is going to build up so that we could pay the tax bills when they're due. If your first payment was due in March, you're going to make one, March payment, April payment, 2 payments, and then there's going to be a 6-month tax bill that's due in May. So we're going to have 2 months in the account guaranteed. You do have a grace period on your mortgages, so we can't count May, but you'll have 2 months of property taxes in that account. New York State will require us to pad the account by 1 month, and we need to collect an additional 4 months at closing to make sure that the 6-month bill is there, right? So 2 months payments, 4 months makes up the 6-month bill, and then 1 extra month for the padding required by the state. At closing in this scenario, we would collect 5 months of property taxes. I'm always going to be showing you at least 8 months of property taxes in this column here, though. And the most common question I'm going to get is, why are you showing me that if you're telling me that you're only going to collect 5 months or 4 months or 3 months or whatever that number is? The reason is because there's going to be a second calculation that's performed at closing. It's going to be performed by the seller's attorney, and the seller's attorney is going to say, hey, wait a minute, my client paid the December tax bill, the first half taxes, and they covered December 1st through May 30th. So the seller's attorney is going to require that you reimburse the seller from your closing date, right, January to April 30th. When we add up the numbers of what's being reimbursed to the seller and what's going into the escrow for the next tax payment, it's always going to add up to 8-9 months of taxes. So we want to be accurate with this number. Homeowners insurance. This is the policy that protects the home itself. So this policy needs to be able to completely rebuild your house in the case of damage, fire, flood. We want to make sure that the policy is in place. The homeowners insurance companies are going to give you an annual policy, and they're going to require payment up front. So a week before closing, you're going to pay your first year of homeowners insurance up front to the insurance company. And then if you're escrowing for your taxes and insurance every month, in this case, $200 will be separated and it'll go into that account and add up and build up. And then next year, when the second year's policy is due, we're going to make that payment for you from the escrow account. For this $600,000 purchase price, I'm estimating the homeowner's insurance cost at $2,400 for the year. Again, you'll make that first $2,400 payment a week before closing. Everybody wants to make sure that the policy is in effect when you're sitting at the closing table. We don't want you signing paperwork and there's a fire at the house and there's no insurance. So we'll have a paid receipt. We'll have everything finalized for your closing date. And then we're going to pad that escrow account at closing, because you are going to have that 30 to 60 day gap from the closing date until your first payment. If we do the math, we're only going to have 10 or 11 months of escrow payments into the account, but there's going to be a 12-month bill that's already due. So we're going to pad that account by a few months on the homeowner's insurance cost to make sure that next year there's enough money in there to pay that expense for you. Important thing with property taxes and homeowner's insurance is it is a prepaid cost. We're moving money from savings over to cover future expenses. Any balance that is in your escrow account, because there's always going to be a balance building up, and then it'll move to lower, then it'll build back up as tax bills and homeowners insurance bills become due. Any balance that is in that account when you pay this mortgage off, either through a sale, paying the balance down to zero, or a refinance, it's your money. It's refunded to you within 30 days of the payoff receipt. Likewise, if you sell the property, there most likely will be a portion of the property taxes that you have paid in advance that will be reimbursed to you by the new buyer. There will also most likely be a portion of your homeowner's insurance policy that has not been used yet that's refunded to you from the insurance company, right? So if you bought the house 6 months later, you get a dream job offer in California, and you're selling this house and moving across the country, you're going to have 6 months of homeowners insurance coming back to you. You're going to have property taxes coming back to you, both from your escrow account and for what you paid in advance. The last prepaid cost is down in the orange. It's prepaid interest. So prepaid interest is a calculation performed by lenders at your closing date. So mortgage terms will always start on the first of the month after you close, and your first payment will be due 30 days later on the following first. So if you were closing, today's January 11th, 2023. If you were closing today, January 11th, your first mortgage payment or your term would start February 1st. Your first mortgage payment would be due March 1st. You're going to have 48, 49-day window here until the first payment. But we, as the bank, we're lending you, in this case, $540,000. There's going to be a per diem interest calculation that's performed. So we take your loan amount, we multiply it by your interest rate, divide by 365 days, and depending on how many days are left in the month, you're going to pay interest per day for the money that was lent. We show you 15 days. That's how most banks do it. If you close earlier in the month, you'll pay a little bit more interest, but you'll have a bigger gap. You close later in the month, you'll pay less interest, but you'll have a shorter gap until that first payment. If you're closing anywhere around the first, we will give you the option on when you want to set that payment date to. So in some cases, if let's say you are closing February 2nd, we could start your term February 1st and credit you interest and have that first payment due March 1st. But we'll talk more about that when we get to, or when we have a closing date set. So these are your settlement numbers. Depending on the options we're looking at, there might be points involved. A point is a fee that is paid to lower your interest rate. So we're always going to show you a 0-point option. The 0-point option is your base rate. It is market rate for your purchase scenario, for your credit score. Again, we're most likely going to be showing you a 90-day lock on that rate quote. You'll have more details in your individual video. If today that base rate's at 5.99%, you can pay fees or higher fees to lower the interest rate. So in this scenario, I was showing a 0-point option versus a 1-point option, and you can see that the cost increases on this, but the monthly payment drops by $83 per month. So that goes more into individual planning, and your individual scenario will be structured based on the goals that we discussed. I always like to take any questions on this, so if you want to set up an individual consultation to go through your individual cost estimate, just you can go into my calendar and select a time. Hope everybody has a great day. Talk to you soon.